I'm going to do another edition of Nasdaq predictions on this specific recording. As if you've watched the last one, you'll understand a little bit as to why I drew these boxes and these lines. I'm just going to recap a little bit as to why I did that. Right now, I'm sitting on the 30-minute time frame, right, just to encompass a few days worth of trades. So what these boxes represent is the indices moving after hours. Okay, so if you can follow the cursor on the bottom, as you see, it says 7:30 my time, so 9:30 Eastern. Right, I'm on mountain time, so everything for me is 2 hours behind. Okay, so 7:30 for me is when Nasdaq opens, and where is it? 1:30 at the end of this candle is when Nasdaq closes. So pardon me, I'm just going to do that. Okay. So what this tells me is there's movement that happens before the market opens and after it closes, right? We all know that. We know that stocks are able to be traded before and after opening hours. The question is how much, right? We know that on Eastern Standard Time, I believe that pre-market opens at 4 a.m. and it closes at 8 p.m. Okay, now what happens to that 8 hours overnight, right? Like, if you take into account that the stock market really is only to be traded between 9:30 and 4 o'clock, you're going to understand that all these moves, right, from 9:30 to 4 o'clock, what they do is this is what happens during peak hours, right? Where hedge funds, where retail traders, banks, whoever else is able to do a lot of trades, especially with options, puts and calls, right? After hours, they're not validated. Only after hours are you able to actually buy the specific stock, right? So you may be asking yourself, if you can't trade the stock, how is it that, from close to open, you have such a massive gap? Sometimes that happens, right? And what you need to understand is all over the world, the indices are able to be traded except for the United States, right? So that means that every country besides the US has access to trade the actual NASDAQ on a Forex exchange, right, through a broker. When they are able to do that, that's when you get this kind of volatility overnight when the stocks aren't even active. Okay, now take a look, for example. I drew this line where NASDAQ closes. Okay, you can see that overnight on February 23rd, it dropped hard. What is the first thing that happened on open on the 24th? It went up to close that gap, right? And look how many points that was. It dropped almost up to 474 points overnight, right? That means that the opening candle from the closing candle was 431 points difference on the NASDAQ. Once that happened, right, for example, I'll use Tesla, right? Tesla's difference between close and open was over $60 on that day, I believe. Like, it closed at 760 and it opened at 699 or 691, so almost $70, right? That's a huge gap. Like, how is that possible, right? And this is why, because the indices itself is being traded, therefore it affects the stock's value. Now, don't quote me on that one. I'm not particularly certain if that's exactly what happens, but based on some trial and error and the theories and conclusions that I've arrived at, it seems to be a very logical explanation. So, during this close and then this open, you can see that this gap wanted to be filled, and it gets filled rather quickly. If it doesn't get filled, it lingers, but it will be filled eventually. Okay? So as you see, this one closed the gap. And as soon as it closed the gap, it kind of hovered for, about 2 hours. It didn't really go anywhere. It went down and then wicked, and it didn't really do much. But finally, at 11:30 my time, so 1:30 Eastern, started moving up, right? Closed and opened relatively similar, but it opened a little bit higher, right? And it dropped hard and then reversed right back to close that gap. Similarly to here, right? You see where it closed and then where it opened. It opened up and it kept going up until that gap was closed, and then it kind of diddled around for a little bit, right? Look at this one. It closed and it opened down here, filled the gap, and then went lower. So what are we to expect tomorrow on the open, right? This is currently, my time is about 11 p.m., so 1 a.m. Eastern. This is where the market closed, and this is, if the market doesn't open exactly on this line, if it opens above, expect that the market is going to go down first thing in the morning. If let's say the indices ends up down here, it's going to open first thing in the morning higher, or it's going to go from a low to a high, right, to close that gap. Now, you don't have to quote me verbatim on this one. I just want you to see for yourself. Look how it's been happening since I've been drawing these boxes up, okay? I didn't go very far. I just went up until February 7th, okay? Let's see how that has played out. Gap where it closed, where the market opened, and then within a few hours, it closed that gap. Where it opened, definitely didn't close that gap that day, but look what happened about 1 hour before open. Right at 8:30 in the morning, everything shot down to meet that, to get everything that was on that gap, and then shot right back up. But as you see, it dropped before market opened 292 points in order to be able to meet and close that gap, and then it went up and back down. But you see, this gap up here wasn't closed. There was nothing that met that particular closing of that specific day, which was February 9th. Which means that we have to get back up there eventually to close that gap. Okay, we've been closing gaps from the past, right? As you can see here, for example, this was 1:30 my time, so 2 o'clock this closed, right? And I'll just draw a ray from here. This is where, oh, let me just click that. This is where it closed, right? You see that red line? I'll make it a little bit thicker so it's more visible, right? That's where it closed. It never met that spot again, right? So we have to come back up there to close that gap. When it's going to happen, I can't really be certain, but all I know is it has to close the gap. It's as simple as that, right? The market itself is a balance game. There can't be more sellers than there are buyers. There's equal amount of both, right? So just as we have gone on, you see every time that the market has closed, and if it opened lower and never came back, those are gaps that need to be filled eventually, right? But we need to focus on what the days are. But as you see, every time we went lower, those gaps were closed almost immediately. It's only when we were starting to drop, that's when the gap stayed open. All right? So my prediction is that Nasdaq is overall bullish now. We've hit our all-time low. Well, for this pullback anyway, we've hit it at about 13,000 and change. And I'm using the NAS US 30 on Oanda. Just there's on different indices, on different brokers have different numbers, right? So just to be specific, I'm using the Oanda one. You know, the IXIC, I believe that's on Webull or other indexes, is off by a couple hundred points, you know, give or take. So really just take that with a grain of salt. Okay. But yeah, as you can see, every gap gets filled. Every gap gets filled. If we have a gap here at open, expect the market to get to that gap first before going in its appropriate direction. Hope that helped. Subscribe and like the videos, and I'll hope to see you for more. Take care.